Practical accounting, the better way to learn.
This is 2.2 certifications and organizations, ethics, laws, and internal controls.
We're going to talk about the rules. You know, we got to have rules. We're talking about accounting, so we're talking about accountants. So you want to pay close attention. There are no computations here, but there's a lot of information here that's going to be very valuable for you to understand. So pay attention to Professor Hillard. Take it away.
Let's take a look. Okay, this, folks, before we get into some more specific things, this is some more important terminology and more why. And it has a lot to do with that trust thing that we talked about in the first module. Okay, these interlocking pieces all work together to protect investors and build trust in conformance with GAAP. All the definitions are in blue, the terms that are being defined. The first one is a public company. A public company is a company that sells stocks and bonds to individual investors. Private companies are smaller and have only a few investors. So a public company is held to a much higher standard. A CPA is a certified public accountant. Certified public accountants have completed rigorous educational and experience requirements and are actually licensed by their state to attest, which means certify, that the financial statements are, quote, in conformance with, which means follow, GAAP, generally accepted accounting principles. By expressing an opinion, they basically go thumbs up or thumbs down or thumbs across. But it's a process that they work with the company in order to make sure that the financial statements are materially correct. A public accounting or CPA firm is a group of accountants. They offer typically audit, tax, and business advisory services to their clients. Their association is called the AICPA, which is the Association of Independent Certified Public Accountants. The Financial Accounting Service Standards Board, or FASB, is an independent organization that has an authority to set and interpret GAAP, make the rules basically, except for there's a separate board called the Government Accounting Standards Board, GASB, which has authority to set standards for government agencies. The last two are actually government agencies. One is the Securities and Exchange Commission, is a federal regulatory agency that enforces reporting standards for public companies. And this is the law enforcement and reporting, official reporting place, except for taxes. That's our old friend, the Internal Revenue Service, which enforces compliances and collects revenue. And each state also has a similar agency for state taxes. So all these work together to protect investors and work to codify ethics, laws, and internal controls within the organizations. Business and accounting ethics are broad shared values that define professional behavior. And there is a motto out there called the 4 R's. And here's how it works. Ethical behavior builds trust, and it works at the individual and organizational level. For reputations that attract new business, relationships which bind you to current business relationships, reduce costs by less haggling and less lawsuits, and risk management, which prevents bad things from happening. So ethics are the broadest societal goals. However, as the economy grows and business practices evolve, laws are passed by Congress regulating financial statements and protect investors. The two primary laws are SEC 33 and SEC 34, which is really a combination. These two, SEC 33 and 34, which was actually right after the stock market crash that caused the Great Depression, was to establish the Securities and Exchange Commission and set initial reporting standards. The next one, and that built a lot of trust. The next one was the Sarbanes-Oxley Act of 2002, which strengthened auditor independence, a really important concept. Auditors need to be independent of their clients, and also made the management and the board of directors more accountable for issuing correct financial statements. One way that they do this is through internal controls. Internal controls are internal processes by the company that protect us against, first term is one of my favorites, defalcation. Defalcation is basically theft of assets. Particularly, you want to guard your cash, but all your assets can be stolen. The other one, though, is financial fraud. Financial fraud is a term which means that companies can, if they produce financial statements that are wrong, it's called a misrepresentation, in order to get funding for contributed capital or for liabilities. That is called financial fraud. When you're doing that, it's incorrect amounts, incorrect classifications, or omissions. So internal controls were strengthened by SOX to primarily prevent financial fraud, and relevant internal controls will be covered in each chapter of this course.
You can get this Excel workbook and a whole lot more
Stuff for free at practicalaccounting.com.
See you there.